All right. Hello, everybody. Welcome back to another episode of the Sunday Futures Show. I hope everyone had a great weekend. If you saw my tweets over the weekend, I did nothing this weekend. I did nothing this weekend. I slept at, I think, 1 a.m. on Friday. I woke up at basically 1 p.m. on Saturday. Stayed up for like 3 hours, went back to bed, and then woke up at 9 p.m. on Saturday. I mean, I slept so much I can't even explain. And then today I woke up at like 12 p.m. again. So it was a great weekend of sleep, dude. It was a great weekend of sleep. I can't even explain the types of dreams I had, because when you're sleeping for basically 20 hours, there's going to be some dreams, and I had some dreams. But I caught up on the sleep that I didn't get throughout the week, because throughout the week, honestly, I was sleeping at like 2, 3 a.m. every single day, waking up at like 7 a.m. So I think I caught up on all that sleep. This week is going to be wild. Thank you, everybody, for being here. We got the futures. Well, futures already open, but we have the overnight markets opening in about 12 minutes. And let me just warn everybody right now, it looks like it's going to be pretty ugly. It looks like it's going to be pretty ugly. This was the futures about 20 minutes ago that I posted, and updated from now, all of these are down about 1%. The VIX is actually up 5%, which is what it should be. It should be up because volatility is higher, as the NASDAQ, the S&P, the Dow Jones, and the small caps are pretty much breaking down. So futures are looking incredibly ugly. Bitcoin has been destroyed, you could argue. I mean, I don't know if there's a better adjective for this thing. I mean, I hope this is, I mean, I was about to say, I hope this is like kind of enough pain, but as I pull up Bitcoin right here, down almost 7% of the day, it is 400. Oh no, we did hit 79. Wow. We hit 79. I think 5 minutes ago. Yeah, look at that. Hit 79,984. Literally it was about 20 minutes ago. And then we got right back up to 80,479. So right now we are 479 points away from below 80,000. There is a lot of method to the madness in terms of what's happening right now. And we're going to go through all the explanations. I'm going to wait until the overnight markets open up and we get through all the opening prices. There have been 2 confirmations this weekend of a theory that Chris pointed out on the market open. I think this was on Monday morning or Tuesday morning. And then I wrote up a thread about it on X, I think that same day, Tuesday. And the theory was that the Fed, or the government, wants the Fed to cut rates. In order for the Fed to cut rates, they need to tank the market so that growth slows down so much that the Fed cuts rates. That allows the 10-year to come down. That opens up mortgage rates. That opens up the housing market. But more importantly, it opens up the Fed to refinance the $7 trillion of debt that we have due in the end of 2025 at significantly lower rates than the current 10-year yield is implying. At one point, that 10-year yield was almost at 5%. That theory that was been floating around really for the past couple of weeks, and we talked a lot about it this week, and some people agreed with it, some people disagreed with it. I think we got 2 confirmations from 2 different people this weekend that we're going to talk about in the next 10 minutes, basically saying, yeah, that's the thesis, and that is the theory. And again, the theory, to make it very simple, and we'll talk more about it, but it's that Trump wants to tank the markets to get rates to come down. And more, I am thinking that this is one of the most obvious things that is happening. That doesn't necessarily mean the markets have to continuously be in this state of perpetual decline. It is a temporary short-term, I guess, fix that Trump has on interest rates, which requires volatility in the stock market that can turn into a recession if it gets really bad. But if the Trump administration plays their cards right, it can turn into a momentary pause, what Scott Bessent talked about on Friday as a detox, which is another word for, yeah, you're going to feel some pain in regards to government spending, which is 30% of GDP. And maybe that can be threaded in a way that allows the volatility for the stock market to get bond yields to come down because people start buying up bonds, and then stocks can go back to the moon, or that could lead to a full-on recession. It's like it's really one or the other, right? And I don't think there is a middle ground for how this plays out. So we're going to talk a lot more about that, and we're going to see kind of how the Trump administration is navigating it. Trump did an interview on Fox News this morning where, again, he kind of basically confirmed that. We'll talk more about that as well. But that's kind of some of the updates over the weekend in terms of what happened. Some headlines before we get into the overnight markets. Again, thank everybody for being here. Well, Canada has a new PM. He was voted just like an hour ago. His name is Mark Carney. Justin Trudeau is no longer the Canadian Prime Minister. Here's what the new PM had to say about tariffs.
The Canadian government has rightly retaliated and is rightly retaliating with our own tariffs that will have maximum impact in the United States and minimum impact here in Canada. And my government will keep our tariffs on until the Americans show us respect.
Okay, so I don't know who this guy is. I am not up to date with Canadian politics. You guys can let me know in the chat if Mark Carney is better than Trudeau, worse than Trudeau. I don't know. But the point is he has a similar tune like Trudeau around tariffs. And, you know, again, on Thursday, the Trump administration came to a quote unquote deal with Mexico about delaying tariffs for about a month. That deal is set to expire April 2nd. We'll see if it actually expires or if it continues to be extended. And then Trump said he had a somewhat friendly phone call with Justin Trudeau, who was the former prime minister of Canada. Now, I guess he's going to be talking to Mark in the coming days. And it's probably going to be similar conversations. Maybe the relationship is going to be a little bit different and they can get close to a deal. But the point is tariffs are still delayed, especially on USMCA products until April 2nd. Now, aluminum and steel tariffs go live on the 12th, which I believe is Wednesday. Yeah, Wednesday. Those, it looks like, there's no negotiation around those. 25% tariffs on aluminum and steel. That is happening like on Wednesday. So that's going to be something the markets have to price in and have to figure out how they're going to deal with it. But the actual auto tariffs, the 10% tariffs on Canada, Mexico in and of itself, that's delayed for another month. I guess we'll get more updates this week in terms of what's going to happen with tariffs. But those were the big updates we got last week. Market reacted to that. Obviously, the market did not love those pieces of news because the market has no idea what the hell is happening with Trump and, you know, how this tariff policy is ultimately being imposed. But the point is, now that we have a new Canadian prime minister, I wonder if that's going to make this relationship even better, or if it's going to make it worse. And we're going to find out probably over the coming weeks. Yeah, Lutnick, we'll listen to what he said about tariffs on Meet the Press today. Again, a lot of the Trump the officials, whether it's Secretary of Commerce, Secretary of Treasury, they're all kind of making the rounds in the media trying to make this argument about tariffs make sense. I am still a little unconvinced myself if the analysis around tariffs makes sense. However, what I am convinced on is what the Trump administration is trying to do when it comes to getting rates to come down. And so I think more than tariffs being affected, they have a broader plan around getting the 10-year to come down, which ironically on Friday was actually up. It didn't come down, which was not the right thing. Now it's down a little bit right here, 4.259%. But we need this 10-year to come down. If we're going to have the markets come down, this thing has to come down with it. If this goes up while the markets go down, then we are entering into stagflation, and that is not what we can have. So we're going to need to see how this ends up playing out. 5 minutes until the market opens. Here's another headline that I just saw about 10 minutes ago. Not macro related, but it is Tesla related. This video is going to be a little bit cringy for some of you. For some of you, maybe you're going to agree with it. But that whole Tesla, I guess, brand image destruction thing that we've been talking about. Yeah, there is a legit movement that is against Tesla.
You need to sell your Tesla. I'm not going to warn you again. Okay? Those of us in the resistance are not going to stand for these hate mobiles driving around, providing free advertising for the man who has subverted our democracy and spread disinformation and hate speech and supported the fascist takeover of our government, and who has taken the food from the mouths of millions of people around the world by destroying U.S. aid and has betrayed Vladimir Zelensky. That is how serious this is. And you continue to pre-order these Teslas, you continue to drive and charge these cars. They're making this man, Elon Musk, more and more powerful, infinitely powerful. That is not okay. It's not okay. We are sending the Tesla stock to zero.
That part got me. The Tesla stock. I don't think this guy really understands like stocks or anything like that, but that part was funny. So you get the point. Obviously, there is a large movement that is starting to get more and more attention. I mean, I guess large is subjective. There is a movement out there. I would say it is getting larger. How large is it is yet to be known. But we do have some other data points. I mean, this is what Kia on their main Instagram post or on their main Instagram page, posted as well a sticker called "I bought this after Elon went crazy." This is not a meme. This is not a joke post. This was on Kia's main Instagram page. They got some backlash from this, but they got a lot of people supporting it as well. So, I mean, it's getting to the point where the brand damage on Tesla, again, my opinion, you guys know, I personally believe FSD, robotics, that stuff massively outweighs whatever political short-term brand problems that Tesla's having. Nonetheless, are they having some brand issues? Yeah, you are getting people that want to aggressively protest against this. And I think a lot of these people, like this guy right here, I think he's kind of sick in the head. Not the guy we just watched. He's probably a little sick too, but this dude who's actively chasing a Cybertruck in New York City and then punching it. Like, you've got to be a little bored with your life, in my opinion, to do this. Ironically, there's a cop car right next. But you've got to be a little bored with your life for you to actually do this walking through New York City. I mean, New York City is where people chase their dreams. They go get their ambitions. Like they fight for success. This guy is pounding on a Cybertruck running through New York City. So the point is, the brand damage is definitely happening to an extent. How bad is it going to be? I guess we're going to find out over the coming months. But there is a broader faction of the global population that is deciding to violate the law by like aggressively vandalizing and hurting Tesla superchargers and cars. I mean, like, it's really ironic to draw Nazi symbols and like bust out the windows and crack the cars of Teslas that you don't even own. Honestly, just creating more pain for the individual driver who's probably not a Nazi and probably doesn't really care that much about politics. They just like their Tesla because it's a good car. So I think the whole thing was ridiculous. But as a Tesla investor, I don't think anyone can ignore the fact that this is happening. And it's something that has to be weighed into when analyzing the implications of the stock right now. All right, we have a minute left, about 30 seconds. I think it's going to be a pretty disgusting open. I think Robinhood, MicroStrategy, all these guys are going to gap down maybe 2 to 3%, if not more. MicroStrategy probably a little bit more. But it's going to be ugly as futures are down 1% across the entire board. We're going to see how individual stocks look like. And then after we go through all these tickers, we're going to talk about why markets probably are going to continue to go down until interest rates come down. And it seems like this is the thesis that is starting to be more and more reinforced by everyone who's seeing what the White House is actually trying to do. All right, here we go. 8 p.m. The overnight markets are open. Let's see how much money we're about to lose. Robinhood is down 8%. That is, well, now it's down 5.45%. All right, MicroStrategy. How about that one? 10% on MSTR, 10.31% down on the day. Robinhood down 5%. Palantir, 1.92%. NVIDIA down 2.34%. Tesla down 2%, 257. Trade Desk down 1.4%. Google's down 1%. Meta's down 1%. We've got Apple down 0.5%. Celsius down 0.33%. The S&P 500 down 0.69%. It is now below the 200-day moving average. It did end green on Friday. It was just slightly above the 200-day moving average. Now it is, again, well below it. That 200-day is at 572. We're at 571. And I think we got to a low of 565 on Friday. Costco's down 0.33%. Costco was down 7% on Friday. The Qs are down 1%. Qs were up 1% on Friday. Tempest AI down 1%. Nike down 0.5%. Intel down 0.68%. AMD down 1.31%. MSTR down 9.4%. Robinhood down 5.6%. Uber down 0.24%. DoorDash is up 6% because they got into the S&P 500 over Robinhood. We'll talk about the S&P 500 news on Friday as well. But Williams-Sonoma, which if you've been part of this channel for a while, you know my history with that company. Williams-Sonoma, Expand Energy, DoorDash, and TKO Group, which apparently owns the WWE and UFC. I had no freaking clue that was public, but that for some reason, I'm not going to get into the rant. But for some reason, pots and pans that cost $5,000 and worldwide wrestling entertainment is more important than the freaking retail revolution of trading that is democratized finance. For some reason, that's what the S&P 500 committee came up with. But anyway, Robinhood down 7.4%, $41 right here. Bitcoin 80,747. That's down about 6%. Nvidia down 2.2. That's at 110. Tesla again down 2%. Let's see some of the other Bitcoin proxies and how they are doing. Rocket Lab doesn't trade overnight, but someone can check the Someone can check the German markets for Rocket Lab, and that'll give us an understanding of how that's going. CrowdStrike's down 0.19%, Adobe's down 1%, MongoDB's down 2%, Salesforce down 1%, Oracle down 1%, Snowflake down 2%, Datadog down 1%, Palantir 2.3%, 8296 right now on Palantir. In terms of crypto, again, MSTR is down 9%, Marathon's down a little bit, Riot's down 7% overnight. That's aggressive. Coinbase down 7% as well. Coinbase also didn't make it into the S&P 500. And then you got BITX, that's 2x leverage Bitcoin. That is down 14% currently right now. Rocket Lab's down 4.5% in the European markets. 4.5%. MSTX, oh boy, I don't even want to look at MSTX. Yeah, that one's down 17%. Yeah, that one's getting hit. That one is getting hit. The only thing that's green right now is DoorDash and TKO because they got into the S&P. Nothing else is really that green, to be honest. I don't see a ton of green. I got a lot of these names that are down. PayPal's down overnight. Intel's down overnight. Where's SMCI? SMCI is down another 2.8%. All the semis should be red. Yep, all of them are red. The only one that's up is On Semiconductor. ASML's down 2%. Broadcom's down 2%. Qualcomm's down 2%. TSM's down 2%. Marvell's down 3%. ARM's down 2%. Lam Research down 2%. Dell down 2.06. Micron down 2.11. NVIDIA down 2.25. Intel down 3. Intel down 2. SMCI down 3. AMD down 1.5. So yeah, it's a red overnight market that's probably going to be red in the morning, dude. I don't think anything's changing it, given some of the stuff we're about to talk about. But we are red. We are definitely red. And you know what? I'm kind of just consolidating my emotions around it because I think it's inevitable. And the reason I think it is inevitable is based on what we're about to talk about. Robinhood is 5 cents away from going below 40, down 10% right here. I think this is a little bit overdone. I know Bitcoin's down, and that's why Robinhood's reacting to it, but 10% down is like Robinhood is not just the crypto proxy. So that's a little weird that it's getting hit that badly. Maybe a little bit more of this is because they didn't get into the S&P 500. Some people were expecting them to get in, and that's why it was down as well. But again, we have been saying this for a while. Robinhood is a proxy on the bull market, right? You need trading volumes in order for Robinhood to do well. Without those trading volumes, and if we get into a full-on, I wouldn't say like 2022 bear market, but a couple months of just like people don't feel like trading, people don't feel like opening up their Robinhood, etc. Yeah, that's not the best for HOOD. Yeah, even though January and February were great, that's gonna help them weather the storm for Q1. If March is really that bad, I think Q1 still is good because of how good January, February were. Also, they've got this whole gold month going on, so I think that's gonna help weather the storm. Obviously, I think the stock, at a less than $40 billion market cap with $5 billion in cash, the PE just continues to collapse. So it gets cheap in the short term. Or in the long term, obviously, it gets cheap, but in the short term, it could be incredibly volatile if markets continue to get hit. So let's talk about why markets are getting hit. Let's talk about why markets are getting hit and why we are going so red. Oracle right here is down as well. Oracle is down, 1.2%, I think? 1.23. Yeah, 1.23. The big ones right here are MicroStrategy, HOOD, Palantir as well, down 2.72, and then Bitcoin just above 81,000, but did get to 79,000 at one point here today. All right, cool. So let's talk about what's going on and what is the reasoning behind some of this ugliness that we are seeing in the equity market. So I think to start off, we should go back to, well, first, before I even go into that, here's what's happening this week. So this week's also going to be a big week for macro data. Why is it a big week for macro data? Well, we have January JOLTS jobs openings data on Tuesday. That's going to be important because no one really believes that we have 8 million jobs open. A lot of people thought the Biden administration was, for lack of a better word, cooking the books on those numbers. We're going to see what the Trump administration puts out as their first JOLTS data of the second administration. Then we have CPI on Wednesday. That's going to be important. We have initial jobless claims on Thursday, which came in a little bit better than expected. Those non-farm payrolls also came in a bit better than expected on Friday at 150,000. We have PPI on Thursday, and then we have Michigan consumer sentiment data on Friday. So it's going to be a big week for macro data. We need a lot of these numbers to come in better than expected. CPI has been rising for the past 4 months. Consecutively. So we're at 2.9% headline. I think that does go a little bit lower given some of the preliminary data I'm looking at. We'll get more updates on Tuesday, but I do think that we're not going to see a 3% headline. And if we do, I kind of think that's what Trump wants. And so let's speak about what the thesis was last week and how that thesis is continuously getting reinforced. So let's start off with this. I put out this thread on Tuesday. We talked about it with Chris on the Market Open. A lot of people have been talking about this idea, but the idea is simple. We have $7 trillion in debt that is going to be refinanced at the end of 2025. If we refinance it at a rate of 4.5 or above, which is where the 10 years at right now, 10 years at 4.2, that's not good, right? That's a lot of interest we're paying on debt that Trump doesn't want to pay that interest on. So what's the thesis? Well, if the Trump admin doesn't want to refinance at a 4% rate, how do you get the 10-year to come down, which would inevitably get interest rates to come down and hopefully get the Fed to actually cut rates? Markets need to show weakness in growth, which is what we've seen in some of the preliminary data. Doge has to be perceived as actually working, aka we're going to cut spending, which will help offset some of the tariff revenue that we're going to lose out on. And then interest rates inevitably need to come down. The way to do that is to create massive uncertainties, aka tariffs. I know this sounds like a conspiracy. I get it. I understand some people say this is a conspiracy, that Trump is trying to create all these uncertainties to tank the market. Based on some of the videos we're about to watch, I really don't think it's a conspiracy. I think it's a calculated effort. You could agree with it or disagree with it, but I do think that's what's happening. Those uncertainties can slow down growth in the short term, get the bond market to start buying bonds ASAP because of how scared they are of touching stocks, causing yields to fall, which is what we need to refinance the debt. Again, you need a catalyst for people to buy bonds. People don't wake up in the morning and say, I'm going to buy the 10-year over NVIDIA. They need a reason for why NVIDIA sucks and the 10-year is so much more attractive than NVIDIA, Meta, Palantir, Robinhood, Celsius, etc. Right? Whatever stock you think can grow somewhat over the next couple of years has to have so much uncertainty baked into it that bonds get more attractive. How do you do that? You kind of make the market feel unattractive, and that gives the Fed the authority to lower rates, which continues to bring continues to bring yields down, particularly on the 10-year. So, although conventional wisdom says tariffs are inflationary, which they are, and the 10-year should be spiking on more tariffs, which, quite frankly, it should, the 10-year is actually going down because it's bringing so much uncertainty to equity markets, aka tariffs, that people are selling their stocks and buying bonds, which is exactly what the Trump administration wants. Now, how do we know that the Trump administration wants that? Well, we have two videos over the weekend that I think kind of hypercharge this thesis. First, we're going to hear from Tom Lee, and second, we're going to hear from Donald Trump itself. Here's what Tom Lee said on the Compound and Friends around how he's thinking about Trump tanking the markets to get yields to come down.
Well, since you brought that up, one of the charts that went around this week, including me spreading it, but like a lot of people were sharing that GDP Now chart. And I know there's some funkiness about the turnover from January to February with some of the data. Let's not take this as an actual forecast, but that's a pretty extreme drop. We went from a 2.8% GDP Now reading from the Atlanta Fed to -4.
Yeah.
Outside of the pandemic, can you recall a drop off of that magnitude? Even if there are all these nuanced reasons for why it's data related and not, or it's a quirk of how they collect the data, it still seems extreme.
Yeah, it's big. I mean, it does paint a picture that economic momentum has slowed. So,
Or the brakes have slammed on. It
Yeah.
looks like to me. Okay.
that's right. At a time when we know even businesses are saying that they've gotten cautious because they don't know what to do with tariffs. So that's why if you look at the markets, they're pricing in a growth slowdown from tariffs, not inflation. And
Yeah.
and so the Fed, I think the White House wants the Fed to kind of get off neutral. And I think it's increasing looking like the Fed is behind, actually.
So if they really want the 10-year Treasury to fall, the yields, keep going.
So notice what Josh Brown says right there. If they really want the 10-year Treasury yields to come down, keep going. What he means by keep going is keep messing with the markets to create uncertainty to get people to buy up those bonds, which causes yields to come down.
Yeah.
Because that yield is not pricing in inflation anymore. Now it's pricing in recession.
Now, that's another key point that Josh makes. The 10-year yield is not pricing in inflation anymore. They're pricing in a recession. The reason they're not pricing in inflation anymore is because if they were pricing in inflation, the 10-year would be going up, right? Because tariffs are inflationary. But what they're pricing in is, hey, let me get my 10-year at 4.5% or 4.2%, because when a recession happens, this 10-year is going to drop to 1%, and I'm going to make a spread between 4 and 1, and I'm going to be very happy that I bought the 10-year right now versus when I buy it in 2026 if it gets down to like 2%, 1%, whatever it gets down to, which I don't think it's getting that low. But and as a result, equities are weak in that short term. The balance here is, how do you not have a recession even when that happens, which is what Tom's about to talk about.
Yeah,
We're starting to.
that's right. And
Okay.
then and the only difference is nobody wants to even get within, 10 yards, a touchdown of stall speed, because it's just too easy to slip into a recession.
So Tom Lee's argument right there is that, hey, it is very easy to slip into a recession. And why is it easy to slip into a recession? Because Trump's playing a dangerous game here. If this theory is correct, and this theory doesn't have to be correct, but it's one of the theories that a lot of people are starting to think as a collective, right? Because everyone's trying to wonder what's happening. It's you can make a mix of a lot of reasons. You could say the tariffs are stupid. You could say it's Trump's ego. You could have a ton of different arguments. But one argument from a sort of economist perspective is, if you look at the relationship between bond yields, the debt we have, and then the ability to get the Fed to actually cut, which Jay Powell has not cut, even though Trump has asked them to cut, and for good reason. Jay Powell's just not going to cut right now because he doesn't see the labor market weakening as bad as it needs to be, which is basically what he said on Friday. In order to create the catalyst for a cut, it's a dangerous, fiery game, right? You're literally playing with fire here about tanking the economy as much as you can to get the Fed to feel that we need to now cut rates because we're slowing down. Why does the Fed cut rates? Either they think inflation's going down, which is why they cut in September. They didn't cut because the market was weakening. They cut in September by 50 bips because they thought inflation was coming down. And it was. We were at 2.4% in September, right? So it was a good reason to cut. But the other reason they cut is because they don't want to be late to the party. And in this case, the party is not going to be a fun party because it's a party of a recession. And in order to front run the inevitable slowdown of the economy, you cut before the slowdown happens so that when it slows down, at least you have the cuts to kind of cushion the slowdown. Now, this is not what Jay Powell did in 2021. When inflation was ramping up, he should have cut, or he should have raised rates while inflation was steadily showing obvious signs of getting closer. But he didn't. He waited till inflation was so painstakingly obvious and the damage had been done to then hike rates. And that's why, obviously, a lot of people got mad at the Fed. This time, it's the opposite. This time, Trump thinks that, hey, the Fed is late. And in order to really slap them in the face and let them know how late they are, we need to get the markets to have so much volatility that the 10-year starts pricing in a recession, not pricing in inflation. And as it prices in a recession, people buy bond yields, people buy bonds, yields come down, and then the Fed has more of a mandate to end up cutting rates. In fact, this is what Trump basically said this morning. And the more I think about this, the more I realize he's telling us right in front of our face that he does not care about the market. Literally last Wednesday, he said, I don't look at the market. He cares about rates coming down.
But you may get it again with these tariffs, right? I
You
mean,
may get
one CEO said to me, my input costs have already started to go up. I'm going to
Well,
have to raise prices.
In the meantime, guess what? Interest rates are down for the
I mean, look at that. Look at that. She just said, hey, one CEO told me that we're going to have to raise our input costs because of tariffs. And his response is, well, in the meantime, guess what? Rates are down. And he's talking about the 10-year.
CEO said to me, my input costs have already started to go up. I'm going to
Well,
have to raise prices.
In the meantime, guess what? Interest rates are down for the last 3-4 days at good levels. I mean, when you add interest rates, you're talking about it's gone down. I've been saying, let's get interest rates down. Nobody ever gets rich when the interest rates are high because people can't borrow money. Interest rates are going down. You know what else is going down? What have I been trying to get down?
Oil.
Energy. Energy's going down. I'd love to see energy go down. Energy is really what caused it. They screwed up my energy. I had the most energy and they screwed it up. Then they went back to it. It was going through the roof. They went back to some drilling, but it was gone. It was hopeless. It was lost. But energy's gone down and interest rates have gone up over the last week. That's a big thing. I love that.
But you may
Look at that last word. Look at that last sentence. I love that, right? Energy has gone down and energy has gone down and interest rates have gone down. Now, interest rates haven't literally gone down. The 10-year has gone down, which is why in Trump's head, he's thinking interest rates are getting ready to come down. Mortgage rates have indeed come down because that 10-year has come down. But look at what he says. That last sentence. I love that. I mean, I don't think it can be more obvious at this point. You can agree with it or disagree with it, but point blank, he is asked, what is the impact of tariffs on a market that becomes volatile? And the way the reporter asked the question is not by literally saying, hey, the stock market's suffering. She says, well, wait a second. I have private CEOs that are telling me they're going to have to raise their input costs, which obviously is going to be bad for consumers because if you're raising your input costs because of tariffs, guess who fronts that bill? Us. If the laptop costs $100 more because the input costs to make the laptop are $100 more expensive, consumers have to pay it. That is inflationary. Trump says, well, guess what? Interest rates are down for the last 3 days. I mean, I think the number one thing that's on his screen in the White House is the 10-year, not the S&P 500, not the NASDAQ, not the Dow Jones. It's the 10-year. And Scott Bessent has basically told us that as well. Bessent said, I think this was on Friday, Bessent said, get ready for a detox, which was, I guess, the politically correct word on how to say it. But that is basically what he said right here. Here's the CNBC piece that he did where he said we have to get ready for a detox, which to me just means a slowing down of the economy.
Percent of Americans are 40 or 50% of consumption. And that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down. And could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period. Top 10% of Americans.
So what he's saying right there is the reason there's going to be a detox period is because 30% of our GDP, which comes from government spending, I don't think a year from now, 30% of our GDP is going to be government spending anymore. Based on the updates we're getting from Doge, based on how much the White House is cutting jobs, based on how Trump, when he was asked on Friday at the Oval Office, hey, what do you think about the private sector jobs versus the public sector jobs? He still said we have too many people in the public sector. He says we need to revitalize through the private sector, which means we're going to get more cuts, or we're going to get more downsizing from the federal government. And that is the kind of way he's thinking about it. SoFi right here down about 3.26% in the overnight markets as well. So I think it is becoming more and more and more obvious, whether you agree with it or not, that the White House, Howard Lutnick, Scott Bessent, Trump, all these guys that are managing economic policy they sat down probably in late December and they came up with their plan. And their plan was, let's tank the freaking markets because that'll get the 10-year to come down. That'll get mortgage rates to come down. That allow us to refinance debt. I mean, quite literally now, when you think of it in hindsight, even when Jim Cramer was talking to Trump on the floor of the New York Stock Exchange, and he asked, hey, should people buy the market right now? And Trump, remember what Trump said? He said, well, there could be a dip, so be careful. I mean, I think he was kind of warning everybody. It's like, yeah, I know the markets are up right now because you guys think I'm going to go gung-ho and make stocks go up. But A, stocks have already been up for 2 years straight in a phenomenal fashion, right? 220% back-to-back years. B, if they're going to cut back government spending, a lot of the reason stocks were up in 2023, 2024 is because the government was spending money as well. And if the government's not spending that much money, if Doge is becoming a real thing, if we need to get the 10-year to come down, and it's not going to come down because of inflation, it's only, there's just no way inflation is going to come down dramatically. I know Trueflation is saying 1.4%, and as much as I love Trueflation's aggregated methodology, if 1.4% doesn't show up for the Fed, then they're not going to cut, right? The Fed is not going to, Jay Powell's not going to get in an FOMC conference and be like, well, we're using this Trueflation index. And like, no, this is not going to, it's a pipe dream. It's not going to happen. So as much as I think Trueflation is accurate about this, and eventually this inflation data will show up in the Fed's data, it might take 6-7 months from now. Trump doesn't have 6-7 months. Trump has to refinance the debt in 6-7 months. And so if inflation coming down is the reason to cut rates, that's not going to be a reason that is apparent to the Fed anytime soon. You know what is apparent to the Fed? A slowdown in the economy. An easy way for the Fed to be like, oh, the economy's slowing down is if that 10-year comes down. Because people buying that 10-year means they're not buying Nvidia, Meta, Amazon, Tesla, etc. And obviously, I think those tech stocks in the long term are much better than a 4.5% yield. But if people are choosing a 4.5% yield over those tech stocks, it means they're genuinely scared. And if they're scared, that means that markets are probably going to be volatile and scared as well. Now, granted, there is a bright side to the story that we're going to talk about in just a second, but we do have some updates on Trump. He's on Air Force One. There's a couple of clips right here posted on X. I'm going to play these clips, and then we're going to talk about what the bright side is to all of this.
All I know is this: we're going to take in hundreds of billions of dollars in tariffs. and we're going to become so rich, you're not going to know where to spend all that money. I'm telling you, you just watch. We're going to have jobs. We're going to have open factories. It's going to be great. All I know.
Okay, so first clip is Trump saying we're gonna get rich. Second clip is about Ukraine.
Look, we have to have peace, and I'm doing this. Money is one thing. We're going to lose. We spent $350 billion on this, but the big thing, human life. Thousands of people this week. Thousands of young soldiers died this week. Hundreds of people died in cities in Ukraine. And we got to get it stopped. It would have never happened if I was president, and it didn't happen. This was not going to happen. By the way, October 7th wouldn't have happened. Inflation wouldn't have happened. The Afghanistan, the way not that they left, but the way that they left, it looks so bad. Probably the most embarrassing day in the history of our country. That wouldn't have happened. A lot of things wouldn't have happened, but it is what it is. I think we're going to have a good time. I think we're going to have a good result in Saudi Arabia, meaning they're hosting the various talks. And we have a lot of good people going out there. And I think Ukraine's going to do well. And I think Russia's going to do well. I think some very big things could happen this week. I hope so.
Trump and Ukraine and a lot of other countries are going to be in Saudi Arabia this week to continue negotiating on peace talks. So I guess we'll get updates from that. If any of those peace talks go well, that could be relatively good for markets, but we're going to find out later this week. Yeah, this is one last clip on tariffs. This is a more extended clip, and then that's it.
Well, I think the tariffs are going to be the greatest thing we've ever done as a country. It's going to make our country rich again. We have many companies, as you know, auto companies are opening up plants now. We've had 4 or 5 announced already, but many more are coming. And we're basically going to take back the money, a lot of the money that we've given away over many decades. We've lost our jobs. We've lost our factories. We've lost 90,000 factories since the beginning of NAFTA. It's not that long ago. 90,000 factories. Think of that. And we're going to get them back. And they're coming back. And they're coming back in records. Look at what happened with the big chip company, the biggest in the world. By far the most powerful chip company in the world from Taiwan. And they're going in with $200 billion of money. And they're going to build something that's going to give us 35-40% of the chip market in one company. No, it's going to bring it back, and I think it's going to make us bring us to a level that we've never had before. So I think.
So again, Trump is convinced on this tariff thesis, and if he's convinced on this tariff thesis, and so are all of his economic advisors. As investors, you have to ask yourself, how do you react to that? Because it's not looking like he's going to change his mind anytime soon in terms of what he's thinking about when it comes to tariffs. Okay, so what is the bright side of all this? Because there is a bright side. So for the past 30 minutes, I've basically been saying that it looks very obvious, and you could believe it or you could not believe it, but based on the data that I presented, based on Trump saying it himself, it looks obvious that this administration, at least for now, does not care about the stock market, even though we know Trump judges himself via the stock market. But for now, I think he's saying short-term pain, long-term gain. Doesn't care about the stock market, cares about bond yields, need those to come down. In order to get those to come down, you create volatility in the markets. Okay, so what's the bright side to this? Well, the most obvious one that I think most people probably already realize is rates come down, right? This is good for stocks. So so someone said, are you going to go short the market now, Mitt? And I'm like, no, the time to go short the market was 3 weeks ago. And maybe shorting the S&P right now is a good idea because we're going to go back to 5,000 or 5,400 or whatever. Maybe it's a good idea. I don't have the guts to do that. In general, I tend to not really go short, right? So I didn't have the guts to do that at 6,200. I'm not going to have the guts to do that right now because after a drawdown in so many individual stocks of 30 to 40%, and then I think 6 or 7% down on the S&P from highs, to go short at that moment when all these indicators around sentiment actually tells you it's the time to buy, and we'll talk about a couple of those indicators in a second, it just takes some big guts, right? You got to be able to do that, and you got to be unemotional about it. And I think it's hard because on any sign of a bounce, your short could get messed up for a long time. So I don't think this is the time to go short. The other reason I don't think this is the time to go short is that if we are getting rate cuts, that's good, right? Like a lot of these companies would love having some good old rate cuts. Bitcoin would love having some good rate cuts. It opens up liquidity. It gets the money printer to start printing again. More and more people have capital. More and more people can refinance things. Like getting rate cuts is net good for asset prices. And I think 2021 is the most, or 2020 is the most obvious sort of emblematic situation of when rates were zero and at one point, I think below zero, stocks went to the moon. The balance here around rates coming down, which is the bright side to this entire phenomena around what Trump is doing with tariffs, is will rates come down at an appropriate rate, no pun intended, to make sure that the stock market, or not just stock market, but the broader, mainstream, Main Street versus Wall Street, doesn't collapse in and of itself. Because if Main Street collapses, what do I mean by Main Street? I mean the local pizzeria, the dollar store, the convenience store. Like if these businesses start collapsing because of the massive slowdown we have in the economy, potentially caused by tariffs in and of themselves, even though the Trump administration thinks tariffs will have the opposite effect, then it doesn't matter if you cut rates. If you cut rates, we're all still screwed, right? Like if the pizzeria can't sell as much pizza, it doesn't matter if refinancing the new oven that they're instituting into the pizza or into the pizzeria, it doesn't matter, right? You could have a bunch of new ovens at a 1% financed rate, but if no one's buying pizzas, then that's the problem. So I think that's why it's a very, very dangerous game. And the only thing that's making me optimistic around this game still being won by the bulls is earnings growth. I don't think NVIDIA, unless they just tariff every last GPU that they sell or something, but I think the Singapore export controls is a relatively non-issue. Like I don't think NVIDIA is going to decline in growth rates simply because of tariffs. I don't think the same is going to happen with Microsoft or Amazon or Google. Will there be some small decline if we have a little bit of weakness? Yeah, because maybe some advertisers don't want to advertise as much, right? But they don't have the money to spend. But if we get into a recession, then yeah, those companies have their multiples compressed even further because they simply don't have the demand for their products and services, which means their flywheel, aka advertisers advertising on Google, are not going to advertise if no one's buying their products in the first place. So they don't have money to spend on Google. So I think it's a nuance, right? And the nuance is, do you believe Trump, the Fed, J-Pow, et cetera, Robinhood right here down 8.3%, Palantir as well down 2.6%. Do you believe they will be able to manufacture rates coming down without tanking Main Street and Wall Street? And even if they do tank Wall Street, let's say the stock market falls another 10-15%, which would be bad. That would not be fun. That would be very aggressive. But we can recover from that when rates come down, right? Because money will flow out of money market funds, it'll flow out of bonds, it'll flow out of treasuries, it'll get into the market, because if Palantir goes back to 40 or Robinhood goes back to 20, I mean, these assets will be incredibly cheap given their long-term trajectories, even if not their short-term trajectories, and money will find them. But if Main Street collapses, then we have an issue. Wall Street can collapse and Wall Street can come back. At the end of the day, these are just numbers on a screen that eventually will go back up as people buy asset prices again. But if people actually start losing their jobs, if businesses actually start shutting down, if Meta starts cutting 30,000 employees, then we've got an issue. Then we've got 2022 all over again, which is literally what happened in 2022, right? Meta was firing 20,000 people. Google was firing 10,000 people. It all led to more layoffs, and those layoffs led to lack of demand. Lack of demand led to decreasing stock prices, and then we kind of bottomed out in December 2022. So I think that's the nuance here. It's a really complicated nuance, but it is indeed a nuance. And again, I think the thesis is starting to check out more and more and more based on what Basent says, based on what Lutnick says, based on what Trump says. They are gung-ho about tariffs. They're not stopping their aggressive path to pursue tariffs, even though they never implement the tariffs, which is the weird part about how aggressive they are, because then when it comes time to sign the deal, they'd like delay it by a month, which also leads credence to the thesis that they don't actually care about tariffs, right? They're just creating all this hoopla to, yes, get some stuff resolved when it comes to fentanyl and immigration, but more importantly, creates volatility in the market. And as a result of that creation of volatility, you get the 10-year to come down because they never actually end up implementing the tariffs in the first place. Here's what Lutnick said this morning on Meet the Press.
Anybody who bets against Donald Trump, it's like the same people who thought Donald Trump wasn't a winner a year ago. Donald Trump is a winner. He's going to win for the American people. That's just the way it's going to be. There's going to be no recession in America. What there's going to be is global tariffs are going to come down because President Trump has said, you want to charge us 100%? We're going to charge you 100%. And you know what they say? They say, no, don't charge us 100%. We'll bring ours down. We'll unleash America out to the world, grow our economy in a way we've never grown before. You are going to see over the next 2 years the greatest set of growth coming from America as Americans. You saw it, 1.3 trillion of new investment coming in America. Think of all those jobs. And remember, each trillion of investment in America is 1% of growth GDP. So Donald Trump is bringing growth to America. I would never bet on recession. No chance. Anybody who bets against Donald.
Okay, so the reason I'm playing that is because this is how the Trump administration people think about his plan. And the reason they think about this plan or this sort of idea of tariffs in this way is because they are convinced that unleashing tariffs either is going to get other countries to decrease their tariffs, therefore net it's good, or it's going to lead to more companies in the United States continuing to manufacture in the United States, which that part I'm a bit more skeptical on. Like, I'm not that skeptical that if we put tariffs on, I'm just random country, Indonesia, if Indonesia has any tariffs on us, they're going to like take back their tariffs. I think that's actually really logical and that could happen. I'm more skeptical on the, a t-shirt company in Indonesia that says, oh, we have all these tariffs, we're going to go make our stuff in Alabama. Like, that part, I'm like, I don't know if that part's happening. But the other part is happening. So this is why I think they're sort of deploying this cat and mouse strategy of tariffs. And eventually we're going to see how this ends up playing out and what this means for bond yields over the next couple of months. Love to Fly Pilot says, this will be short-term pain and opportunity to buy the dip. Trump 1.0 in 2018 had the same tariff volatility along with the rates increasing. We will be fine. Buy the dip on good stocks. That is also my opinion as well. I think if NVIDIA continues to fall, if Palantir continues to fall, if Tesla continues to fall, those companies are phenomenal companies long-term. And because they're phenomenal companies long-term, and they will continue to be phenomenal companies long-term, even in the midst of short-term volatility, Meta, Google, Robinhood, et cetera, they will be great buying opportunities. But those buying opportunities, unfortunately, might be dips that keep on dipping. And as much as it sucks, granted, if you bought anything in 2022, you've done very well, right? Maybe you didn't get the exact bottom in October, December, but even if you bought in July or in April, you bought the S&P at 430, if you didn't get it at 410, which was the bottom in 2022, the S&P is at 570 right now. You're feeling okay. But it begs the question, 2025 might not be the year where people see their stock market gains. Now, I still think by the end of the year, we end up higher than these levels. I think we're going to be okay. But if we don't, then it would be a year where you allocate and buy things that get incredibly cheap, because I think everyone has their levels on which, if Robinhood goes back to 20 or like just stupid, ridiculous prices, like, yeah, those would be things that it's a no-brainer. But it might not show you the results in 2025 of those no-brainer prices. It might take another year from now. Maybe. It really depends on how strong the administration wants to be about tariffs, how much they want to implement them, how much they think that this can reduce bond yields in the short term. Maybe if bond yields get to 3.5%, they completely get rid of tariffs because they did what they needed to do, which is get these bond yields from 5 to 3.5. And now they're ready to kind of go back to degrowth and just continue to stimulate the economy with all the ways that people thought Trump was going to stimulate with deregulation, yada, yada. I think we're going to find out probably in the next couple months. But right now, these are the theories that are floating around for how the markets might end up reacting to what Trump is doing. Nunzio, thank you for the $5 super chat. Will Hood get wrecked tomorrow because of what is going on with crypto? You are correct about your question, except the word tomorrow, because it is getting wrecked right now. So it's down 8% right now. I mean, yeah, if Bitcoin doesn't come back, it's probably going to get wrecked tomorrow as well. I mean, I think all of us, at least for the past couple of days, I've been saying you might as well give us below 30. At this point, Hood's price action has been just so disgusting, and that's really because the market's been disgusting. Again, Hood is a proxy on the market, and so if the market continues to fall, Bitcoin right here barely holding 80,000, 200 points away from going below. Yeah, Hood's going to fall with it, and I think it'll become even more attractive at that 35, low 30s level if it gets there. But even if it's attractive for the long term. It's not really attractive for the short term unless we have a meaningful reversal. And the only way we get that meaningful reversal where Bitcoin goes back to 100K or Tesla goes back to 400 is if we have a total paradigm shift around tariffs, which it doesn't seem like that's happening anytime soon. And yeah, that is my synonymous of how this is happening, or why this is happening currently right now. Wouldn't the influx of lots of options activity benefit Hood? It would benefit them for like a month. And then after that, everyone would stop trading because they would be so upset with the markets. People wouldn't want to look at their portfolios, yada, yada. So I mean, yeah, you'll probably have people, buying and selling options, and covered calls will be doing very well, all that stuff, but it's not going to be the type of momentum that a bull market brings to Robinhood in terms of trading volumes. That's just what I've seen historically by looking at their earnings. Maybe I'll be wrong. Maybe all the downside volatility will have tons of trading volumes, and that's actually good for Hood. Maybe. But historically, it's good for like a month, good for a couple weeks. And then after that, people don't want to trade anymore. People don't want to open up their Robinhood app when you're down a lot of money. People don't want to deposit more money into the platform, right? So it just ends up hurting it from a lot of different angles. So this is how I'm thinking of it. Did you say synonymous instead of synopsis? Did I say that? Okay, and then synopsis, not synonymous. You guys know me. It's par for the core for me to say these weird phrases. Anyway, this is the way I think it could play out. Trump wants to create volatility in the markets in order to get bond yields to come down. Either that causes a recession because of a growth scare, and you get bond yields that go well below 3%, and then we start the re-stimulating of the economy. Or, I think that's one scenario. The other scenario is it causes a growth scare, but not a recession. The Fed cuts rates because they're quick to the problem versus being reactionary to the problem after it's too late. The cutting of the rates does exactly what Trump has been saying he wants, which is low rates to be able to refinance debt at a significantly smaller rate than what we have right now. That holds up asset prices. Maybe Robinhood doesn't go all the way back to 65, but maybe it doesn't go all the way back to 20. Maybe it stays stuck within this 35, 40 range if rates come down. It keeps Main Street stable because now you can buy that laundry machine, that car, that house because you have lower rates. So people want to spend more so they can keep financing all this stuff. And then inflation, if it is lifted up by shelter, can start to come down. Granted, hopefully the housing market doesn't create more inflation if you unlock all this demand with lower rates. So that's another variable we have to think about. But if inflation comes down, growth can slow down, but not slow down that aggressively. That is that soft landing kind of Goldilocks zone that I think Trump and the Fed would be hoping for. Which quite literally is the definition of a Goldilocks zone. You have inflation coming down, you have growth coming down enough to get rates to come down. And once rates come down, growth goes back up, inflation normalizes or continues to go down, or if inflation accelerates, it's a very slight acceleration. And that is the zone that I think the administration is hoping for. The second option would be a lot better. And my bet is on the second option. My bet is not on a recession. I don't think the characteristics of a recession can happen as meaningfully. I know everyone likes to fearmonger about a recession, but you still need a lot of stuff to go wrong for a recession to happen. And I think based on these tariff threats, the key word there is that they are still threats more than actual implementations of tariffs. And the fact that they've been delayed 3 times already, I think April 2nd, they probably get delayed again. If they don't, then yeah, we're in a full-on trade war. If they do, it continuously becomes this thing that's not really real, which I think holds up the ability for the economy to not go in the gutter if we have massive tariffs. And that's kind of how I'm seeing it play out right now. Do you think you could explain this to your parents and sister at the dinner table, or are they going to be like, you owe me money? My dad asked me the other day, like, what's happening? And I tried to explain this, and he was just like, what the fuck are you talking about, dude? It's just like, I was like, what the fuck? He's like, what are you talking about? And I'm like, no. It like you got to understand. He's like, I don't care. Like, my mom tried to, I was trying to explain to my mom. She was like, so my mom was like, are stocks going up or down? That's all I care about. I'm like, they're going down. She's like, okay, fine. Like, I'll buy more. That's like, no one really cares. Look, the only people who care about this is the people that are here right now on a Sunday night when you could be watching anything else. By the way, The West Wing, I binged like 5 episodes this weekend. Top 10 show of all time. I'm saying it right now. Top 10 show of all time. I don't care who disagrees with that take. You're wrong. If you disagree with it, you're wrong. It's a top 10 show of all time. But the only people that really care about the nitty gritty of how this is happening is us. Everyone else is just like, are stocks going to go up or down? The answer, in my opinion, is down in the short term. It is what it is. And that's it. We got to learn how to deal with it. The best thing we could do, I think, for all the junkies that are addicted to the stock market is write some covered calls. That's it. Write some covered calls. That's the way to, unless you're going to buy puts, which again, the problem with buying puts is that if you're wrong on the timing, your put premium goes to 0. Granted, if it's a hedge against your portfolio, if the rest of the portfolio goes up, then theoretically you should be okay with losing the put premium. The problem is if the portfolio is flat. Like, no one ever talks about if you buy puts and then the stock is flat and it doesn't go down, your puts don't really print. And you don't, and it's not really a hedge because it's not like this portfolio went up so you can compensate for the loss you take on the put premium because the portfolio didn't go up. It was just flat. But if you write a covered call and the stock is flat, you still generate the premium. So if I write a covered call on SoFi at 15, SoFi's at 1250 right now, and SoFi stays at 1250, I collect all that juicy covered call premium. Even if I'm down on the shares, at least I'm mitigating my loss a little bit with the covered call premium. If I buy puts on SoFi for $10 and SoFi stays at 12 or stays at 11 or stays at, I don't know, 1150, whatever. If it doesn't meaningfully go up back to 15, you just lose all that put premium, right? So I think my strategy here is, as someone who doesn't really buy puts or short the market, is you got to sell some covered calls. In this world, if people are still willing to pay a decent premium on Tesla, Nvidia, SoFi, etc., Rocket Lab, even Palantir, those are the companies I think you sell covered calls on and you try to manage them as appropriately as you can. But I don't think this is a sell everything, get out of the markets. It's 2022. That's personally not how I'm thinking of it. That's what we got, folks. That's what we got in this current market. What does everyone think? What does everyone think about what Trump's doing? Do you agree with it? Do you disagree with it? Do you think it makes sense? I think there's a lot of people. I mean, I read a lot of comments on Twitter over the weekend. A lot of people are saying, yeah, this makes sense. This is what you got to do. And then you got a lot of people are like, this is the dumbest shit ever. I can't believe he's doing this, yada, yada, yada. I think there's a lot of nuance to it. The one thing I will say is we are in $36 trillion of debt. We've got to do something, whether it's Doge, whether it's getting rates to come down to refinance the debt, because we can't refinance at 4.5%. That's just ridiculous. By the way, Trump did want to finance a lot of our debt for 30 years and 50 years at like 1 or 2% back in 2017, but he never got approval to do it. That would have been the smartest thing we could have done, but we just didn't end up doing it. So my point is that we are in a situation which is tough to deal with. And for those that are saying, well, just raise taxes because that makes everything easier. It's like, it's not. Like, you can't just keep raising the taxes. Like, raising the taxes will lead to some level of slowdown in growth. And then we're going to have a GDP growth slowdown. Tariffs I don't think are the best solution either, but it's like things you have to weigh against each other. Thankfully, I don't have to be the one to make the policy decision because I'm not the president, but it is nuanced. It is tough. I don't think it's black or white, like Trump's completely wrong or Trump's completely correct. And whatever, I mean, if Harris was in office, I'm sure we would be criticizing all of her economic policies as well, because it's never perfect. But something's got to happen. And I think the only thing we can do as a community is analyze what the administration is trying to do. And I think they're trying to get yields to come down. And the only way to do that right now is create a growth scare. And that growth scare seems like it's happening pretty obviously, given how the futures are telling us that the market does not like what's happening right now, which again is what Trump wants. He wants the market to not like this in the short term. Style says, admit in a good way, at what age did you become a nerd? That is such a compliment. Thank you so much for that question. What age did I become a nerd? Dude, I think I've been a nerd my whole life. Like, dude, I was on YouTube at 10 years old watching documentaries, bro. This is why I don't have any cultural knowledge about like movies and stuff. Because I've always been a nerd. So I guess, I don't know, since I've been a little kid, I've been a nerd. Okay, let's see what you guys are saying. Carla says tariffs are stupid. Sandro says raise taxes on billionaires. I know that's one solution that some people are thinking of. Personally, I don't know if that's the best solution, but I know some people are thinking that raising taxes can solve our problems. Chadwick says stop spending. This is what I think the Trump administration is trying to do with Doge. Question becomes, is it enough to create the reaction in bond yields that Trump is trying to get right now? Gary says just go to World War III. Oh my gosh, dude. Just to remind everybody, we're still only down freaking 1.68% year to date. Like, I know it sucks. I know we're not going to the moon like we did in 2023, 2024 every other week, but I mean, it's still not the most amount of pain that I think most people have lived through before, which means it can get more painful. That's the downside to it. But it also means, like, hey, with all this volatility, we're only down 2%. There's a little bit of a bright side to that, to an extent as well. What rate target is Trump looking at? So no, I don't know. My guess is 3.5% on the 10-year, which would create, basically 3.75 to 4% on interest rates, or 3.5 to 3.75. And again, the CME Fed probabilities went up to 50% in May after getting, actually, no, sorry, I forgot. They went down to 36%. So they went up to 50% on Wednesdays or on Thursdays, jobless data, where we lost 172,000 jobs in the month of February. But then the non-farm payrolls that came out on Friday said we added 150,000 jobs. And J-Powell was very happy about that. When we listened to him live on Friday, he was basically saying the labor market is in check. That 50% went down to 36%. This is not good for Trump. Trump wants J-Powell to cut rates. If we have a very good labor market, we're not going to get rates to come down that easily. That could also be part of the reason why Trump is creating so much volatility in the government job sector. He says it's because he wants more private revitalization, but also it could be because he wants that unemployment rate to come up. And one of the easiest ways to get it to go up is you fire a bunch of people in the government. And then boom, J-Powell looks at the unemployment rate going higher. And then he says, all right, it's time to cut rates. Again, don't know if this is how the thesis is going to play out, but given the uniqueness and how peculiar the administration is being on these core topics, I think that's how people are theorizing this administration is navigating the job market. I know it sounds crazy. I get it. But again, if you listen to Tom Lee on the Compound and Friends, which I think a lot of people can respect Tom Lee, this is pretty much exactly what he said. This is how he thinks it's playing out. And then Trump told you to our faces today on Fox Business that this is what he is, quote unquote, trying to do without saying that he's trying to do this. And so, I guess we're gonna have to figure out ultimately how this affects the broader market. What do you guys think about Palantir joining the S&P 100? All right, so let's talk a little bit about Palantir. So this happened on Friday. Look, this is cool, but this wasn't really news to me, guys. This is not this is not going to change Palantir's trajectory, and it's not going to pump the stock either. Palantir getting into the S&P is what mattered. Palantir getting into the S&P 100 is just like being part of a higher layer of the S&P 500. So like, yeah, I'm happy for that. It's cool, but that's not really, it's just, this wasn't big news. People were acting like this is big news. I'm sorry. And I'm one of the biggest Palantir bulls that's out there, but this is objectively, this doesn't matter. Like getting into the S&P 500 is what matters. This is more symbolic than anything. I don't think there's going to be a ton of new funds buying Palantir because they're in the S&P 100. And if they are, that's probably just going to offset people that are selling right now because they're scared of Palantir's multiple right now. So that to me, yeah, it's news, but it's not news that necessarily matters. Now, here's news that does matter on Palantir, which is an acknowledgement by Satya Nadella, the CEO of Microsoft, about what Shyam Sankar and Alex Karp, CTO and Palantir, have been saying for the past couple of years, which is that the models are getting commoditized.
AI, and we have the IP rights, and so therefore we will want to build, like we built 5, Mustafa and team have capability that they had in Pi before. We have it in Microsoft. And at this point, if you wanted to just to prove out, that doesn't make sense. I do believe the models are getting commoditized. In fact, OpenAI is not a model company. It's a product company that happens to have fantastic models at this point, and which is great for them and great for us as, both partners of theirs. And so
I completely disagree with that. OpenAI is not a product company. It is a model company because they don't have any products. ChatGPT is a model. So I think that's a nice little spin of the words, but OpenAI is absolutely a model company. That's all they are right now. They're not a product company because they don't have any products.
So I want to go now where I think the industry structure that's emerging, models by themselves are not sufficient, but having a full system stack and great successful products, those are the two places. AI.
Okay, now who said this in June of 2023, that the models will be commoditized? None other than Mr. Shyam Sankar. This was back in June 2023. This was the first AIPCon.
And as I've been thinking about this, I've been thinking, where is the value likely to accrete? And I believe it's going to be in the workflow and the application layer. And that should be quite exciting for all of you here. And that's because the models are already commodities. The pace here is accelerating and exhilarating. This slide, I made it a few weeks ago. It's already out of date. Falcon has been released with an Apache license yesterday. So we've gone in less than 2 months from Llama to Alpaca to Vicuña. We've gone from GPUs to CPUs. We've gone from massive cloud software stacks to running these models on a Raspberry Pi. So the editorial from this, what does this mean? This means that you're likely going to have a menagerie of models, not a single model. And you're going to be able to cheaply customize and tune these models to your needs.
Shyam Sankar was prophetic right there. I mean, what he said in the first AIPCon, that you will have a ton of different models and you'll be able to choose whichever model you want, and each of the models will become commoditized, aka you can use Gemini, Anthropic, XAI, GPT, whatever you want. That is exactly what's happening right now. It's exactly what's happening. Again, the switching cost for a consumer is zero. I canceled my GPT subscription yesterday because I'm using Grok. So it was very easy for me to switch from one to another. ChatGPT's main source of revenue right now was API calls primarily, but a lot of it comes from consumer as well. If consumers start switching, that subscription revenue goes away, and they don't even make any money on the subscription revenue because it's not profitable. Now, the enterprise clients that GPT has are important. However, I think that's where Palantir wins. I think having an actual operating system, an ontology, security, governance for the model, all of that stuff is Palantir's bread and butter. And then I think if you're an organization and you start using Grok or Llama or Gemini as your main API that you call your queries against in order to have actionable workflows, which again, that's what AIP kind of consolidates everything to happen. And then you can just switch between the models. If you stop using 4.5 and you start using Grok 3 or Grok 5 when it comes out, when GPT's at 7 and Grok 5 is better than GPT 7, then where is the competitive advantage? Where is the moat? Like, I think the moat for the models fundamentally lies in how good the model is. It's just that simple, because it needs to keep you on their model versus another model. And right now, I think everyone, from all the objective benchmarks I've seen, Grok 3 is blowing everyone away. Now, maybe OpenAI is coming out with something soon and it's going to be even better, and they're talking about PhD level agents or whatever. That's fine. Is that going to be enough to succeed in the enterprise or in the consumer world, or with some new product like a robot that they might be working out? I just wouldn't invest in OpenAI because I can't see any of those things happening. I think on the enterprise, they're not going to win. I think on the consumer, it's very obvious they're losing right now. Even if they have the most users, that's not enough of a sticky moat because a lot of people are just using a lot of other products. Google just launched their Perplexity killer the other day, which we'll take a look at right here. And, so Google has their own different ambitions in terms of how they're creating search generative AI overviews. And then you got a bunch of other model companies competing for that application layer as well. So I think what that means is, in the context of Palantir, that Shyam and Alex were way ahead of the curve. I mean, literally that video is from 2.5 years ago, them predicting that the models will become commoditized. That is exactly what has happened. Satya Nadella is recognizing that today, which I think if Nadella knew that OpenAI was going to become a commodity, which is what he just admitted in that video, he would not have invested $13 billion into OpenAI. Because what did they get from that other than the branding? Like, someone tell me, what's the ROI? What did they actually get from that? Some people were like, oh, well, Azure AI is having more business because of their partnership with OpenAI. I mean, to an extent, sure, but Azure AI is handling AI cloud workloads that they were going to get that demand regardless of their partnership with OpenAI. Is OpenAI using a ton of those Azure credits? Sure, but that's not generating real revenue for Microsoft. That's part of the $13 billion that they gave them. They just wanted them to be exclusive on Azure. So maybe from a branding perspective, that helped. But in terms of that 13 billion turning into like 100 billion or whatever, especially now that they invested in a nonprofit and now it's like a profitable company, but there's still some legal stuff that they're dealing with as well. I think that's where we're getting issues. And those issues are becoming more and more prevalent to the point where that 13 billion, it seems like it was wasted because they could have sat back and not invested anything. OpenAI would have got some person like SoftBank to give them billions of dollars. By the way, those billions of dollars literally just went to NVIDIA. It's not like that money was spent in any special way. It just bought more GPUs. And all these different model companies would have rose at the same time. Now, Microsoft 2 years later could have picked any of these model companies to partner with without putting a $13 billion stake into those models. And this picture right here, I think, kind of makes it even more obvious. This is what someone tweeted over the weekend. They tried to do something with Copilot. This is what Copilot said, which is Microsoft's core AI product. I understand that you want to improve the formatting of a specific field in your document. However, I cannot make changes directly to your document. Like, if Copilot can't change your document, I mean, like, what are we doing with Copilot now, right? So, look, I don't think this means Microsoft is dead or anything like that. Microsoft stock has been dead for the past year. It's not been the best stock out of all the Max 7. However, I do think Microsoft has some soul searching to do, and they've got to figure out what is their AI moat. And is it just cloud? Because if it's just cloud, that's not that exciting. And they promised investors a lot more than cloud when it comes to AI revenues. So this is another angle to the overall AI trade that I think we're gonna have to find out as well. Will this affect NVIDIA? Yeah, this is just gonna mean more chips for NVIDIA. unless AI progress hits a stall, and then there's no much more to go higher, which again, I just disagree with that. But if that were to be the case, that would be bad for NVIDIA. I don't think that's the case right now based on everything I've seen and all the new data coming out. It just means OpenAI might not be the one that's going to win the race. It was ironic. Again, it was funny because the reason Sam Altman tweeted that they can't find as many GPUs or that they're running out of supply is because everyone was like, well, Jensen gave XAI all the GPUs. And he put you as second priority because XAI is actually like building like really meaningful stuff versus you guys. And so one can make the argument that XAI is going to be the winner here, not OpenAI, which is good for NVIDIA because Elon's getting ready to buy another couple million GPUs. But it would just be bad OpenAI. Like every conclusion I get to is bearish OpenAI, bullish everything else. And I have no idea why, what's his name, Masa-san from SoftBank is getting ready to finance $16 billion in debt just to invest $25 billion into OpenAI. It makes no sense to me unless he knows they're working on something that we don't know about. But he's getting ready to put more money into them. And I guess we're going to see how that money ultimately plays out in the long term for an ROI. The one thing I do know about that $25 billion is a good chunk of it's going to NVIDIA. So that's one way to get exposure to it, is just have more NVIDIA. Google's still down 1%. Meta's down 1.3%. You've got NVIDIA down 1.5%. You're getting a little recovery. It's not as bad as it was 20 minutes ago. Where is Hoodie? Hoodie's at, it was down 9%. Now it is down 6.3%, which is nice. Again, very low volume in the overnight markets tomorrow at 9:30. I guess we're going to see how bad things get. But we do have some red overnight, even if it's not as much as it was before. That's what we got, folks. That is what we got. Someone says, what is the thing that can immediately change Bitcoin's momentum in the next 2 weeks? You know, I've been thinking about this for a while. Honestly, I don't know. What do you guys think? What do you think changes Bitcoin's narrative and momentum? Because I thought it was going to be the reserve. That turned out to be a dud, a complete dud. I mean, let's hear David Sachs talk a little bit about it, but I think the reserve is, I think it's stupid. They're not telling us how they're going to buy. The crypto summit was also stupid, bro. Like everything this administration is doing in regards to crypto is all smoke and mirrors, in my opinion. And people can disagree with me, but no one's given me an actual explanation how they're going to fund the purchasing of Bitcoin. No one's been able to, someone said, some people are saying sell gold. We're not going to sell our gold. We're not going to redirect funds from the IRS to the crypto. Like it's all bullshit to me, in my opinion. None of it's real. And that's why I think Bitcoin's reacting like this. Is it good long-term? Yeah, but this is not what people voted for. People voted for a real plan. And in my opinion, this is not a real plan.
Public and investors, why you need a Bitcoin reserve at all?
Well, good to be here. I mean, the reason why we need a Bitcoin reserve is that the federal government already owns some. In fact, it obtained around 400,000 Bitcoin over the past decade through criminal and civil forfeitures and seizures. And so the government has to have a strategy for how it deals with this. In the past, the strategy has been simply to sell it, in an ad hoc way, almost willy-nilly. And that cost American taxpayers something like $17 billion in lost value. So we want to have a long-term strategy to maximize the value of these holdings. And we've decided that Bitcoin is scarce, it's valuable, and that it's strategic for the United States to hold on to this as a long-term reserve asset. So that's the plan with the 200,000 Bitcoin that we believe are in the possession of the federal government. And I say we believe because no one really knows for sure because we never had a proper audit. So that's one of the first things that this executive order provides, that we're going to do a full government-wide audit to find out what digital assets we actually have so they can be safeguarded and moved into a strategy that maximizes their long-term value.
Look, I agree that's a good thing. I'm not against creating an audit and actually kind of interrogating what digital assets we have and then putting it into like a quote-unquote reserve or a stockpile, whatever you want to call it. All of that's good. The problem is it doesn't go far enough. Now, maybe I'm being a little bit too greedy by saying it doesn't go far enough, because at least this is a first step. And the fact that the White House is having a crypto summit and, you got Saylor and Coinbase and Vlad from Robinhood all in the same building, that's like a step in the right direction. Of course, I think that goes without saying. That's a step in the right direction, but no one voted for a step in the right direction. People voted for the United States federal government buying Bitcoin, and they have yet to announce how they're going to do that. And I'm very skeptical that they are going to announce anytime soon how the hell they're going to buy Bitcoin. To spend money, you need to be able to actually get authority to spend that money. And I don't think it's going to happen for a while. I also think it's a low priority for Trump. I don't think he cares enough about that. Maybe David Sachs cares about it, but David Sachs got the crypto executive order that he wanted. I don't know if he's going to get that much more anytime soon. And that is why Bitcoin's, I mean, you got to ask yourself logically, why is Bitcoin tanking from 97 to almost 79 when the United States of America, the biggest economy and one of the most important countries in the world, has legitimized this asset class by acknowledging it and saying they're going to start a crypto strategic reserve? Why would you sell the news on that? And I think you would sell the news is because there's no explanation of how they're going to keep the asset inflated. It's just an executive order of not selling it. It's like, well, no shit. No one was going to sell it. I mean, Trump wasn't going to sell it. I mean, he can't afford any political capital based on the crypto population that voted for him to sell the Bitcoin. So we knew he was never going to sell it. The question was going to be how he's going to buy it. And I don't think anyone has any idea on how that's going to happen. Which is why I don't think there's a catalyst for crypto anytime soon. The only catalyst I can imagine is rates. The economy slows down so much that rates go down, right? And we get rate cuts, which is good because it opens up liquidity. The problem with that, again, goes back to that nuance we talked about for 20 minutes, which is rates can come down, but if they come down because we have such a slowdown in the economy, Bitcoin's tanking, the NASDAQ's tanking, everything's tanking because they're not going to be elevated just because rates come down. Now, if it's nuanced enough where rates come down, inflation comes down, growth slows down, but it doesn't slow down enough to crack and the rates serve as a cushion. So when it does start cracking, those rates can help protect asset prices that are falling, and then Main Street that is starting to get a little bit weaker. And then you have this kind of small reversal that ends up turning out to be still bullish by the end of the year. I could see that happening. That's going to be hard for it to play out exactly like that. Granted, that's kind of how it played out in 2024, right? Everyone thought there would be a recession, but like we kept finding a way to allow the markets to go higher because rate cuts inevitably were helping to an extent, and inflation kept coming down. There's a world where that happens, and then Bitcoin survives. But there's also a world where we just get everything flushed out, which is what Tom Lee thinks, right? Tom Lee thinks 60,000 before 250,000, and he thinks we get a flush out before we get a lot more momentum on Bitcoin. The ETF announcement was also a sell the news. Yeah, but the ETF started getting real money to come in. The beautiful thing about the ETFs is although it was a sell the news in the short term, people started buying the ETFs. In this Bitcoin strategic reserve announcement, there is no buying of Bitcoin by the federal government. And so to me, it could be a sell the news and then bounce back. But like the catalyst for it to bounce back would be the US puts up $1 billion a year, $2 billion a year, $5 billion a year, $100 million a year to buy crypto. And they haven't said they're doing that, which to me is to me, that's the issue right now. Matt says people are impatient. Within the last 12 months, we've gotten the SEC approved Bitcoin ETFs, now a federal Bitcoin reserve. Yeah, I don't buy that argument. I don't buy it. I think like if the goal is for Bitcoin to go higher, we can't have the argument that we've made so much progress so far, because that's not what Trump ran on. That's just not what he ran on. Like, we have to be honest. Trump ran on buying more Bitcoin, and that's not happening right now. So I like, am I grateful that like the administration has even set up the process to create a strategic reserve? Sure. But they're not buying more Bitcoin. And I think we can't sugarcoat it. Like, they're either going to buy more Bitcoin or not. Right now, they're not telling us they're buying more Bitcoin, which is why crypto's tanking. No one cares, bro. No one has time for these games. Like, no one cares. People are already so scared of the current state of markets. They're not going to have their money stuck in an asset class that they think is not going to be productive at all. And in fact, is the most hyper volatile asset class to the downside, even if it's also the same to the upside. But on the downside, people get scared if we feel that there's not a bidder coming in to buy a Bitcoin. And it's not Michael Saylor unless he raises more money. But this guy's already freaking, raised what, $21 billion and spent most of it, right? He spent $2 billion last week. Like, where's the money coming from? Where is the money coming from? That is my concern for this. Granted, I don't care that much. I don't have a lot of Bitcoin. My proxy is Robinhood, and like, yes, Robinhood benefits from Bitcoin, but if Bitcoin goes to zero, I don't like. I am still going to be long hood. I don't really care. I'm not balls deep into MicroStrategy, and I'm like, I need Bitcoin to go up, but a lot of people are, and the people that are like, they're waiting for a reason to get this thing to come back to life. And if it was the federal government buying it, that's not going to be the reason anytime soon. And look, I will gladly eat my words if David Sachs comes out in a few weeks and says, hey, we're buying a shit ton of Bitcoin. I just believe it's not going to happen because no one's telling me where they're going to get the money from. No one. No one has an argument for where they're getting the money from. They're not going to like get the money out of thin air. They need to appropriate the money through Congress to buy the Bitcoin. I don't think Congress is going to give them any leeway on this. And again, going back to the ETFs, this is the ETF inflows over the past, 3 weeks. Every single day on Friday, the ETFs lost $409 million. There is no bidders. The ETF's not bidding. Michael Saylor's not bidding. All the meme coin people got wiped out already. They're not bidding. And if they were bidding, they weren't going to bid Bitcoin because they're in meme coins in the first place. I mean, like, who's bidding? Coinbase isn't buying any Bitcoin. The random Japanese companies like Metaplanet that buy, $80 million of Bitcoin every other month, like, that's not going to be enough to move Bitcoin. Who's buying Bitcoin? That's the question. It's got to be the feds at this point. If we want this reserve to sort of show Bitcoin getting momentum, and I just don't believe they're going to buy Bitcoin. You know what people are buying, though? You know what people are buying? Gold. Gold just saw the largest 4-week inflow in history of $4.9 billion. I mean, this is my point, right? Like, it's just like people are getting scared. And if they're getting scared, that means they're not going to pile into the most hyper volatile asset of all time. They're going to pile into something that's safer. Now, this might not be the right strategy. Like, gold might not be the right way to play this. Maybe Bitcoin is for whatever reason, but this is just general kind of human psychology that we've seen time and time again. When people get scared, they don't go to something super risky. They go to something super safe, which is why bond yields are coming down. They're going into safe things like bonds or money market funds that we saw $110 billion get added to. Now we have $7.03 trillion in money market funds. It's not going to Bitcoin. And again, this is not bearish Bitcoin. I think we can be objective here and say, hey, like, Bitcoin is a good idea and it makes sense. And I do believe long-term it can be much, much higher than $80,000. But the point is someone has to be buying it for that to happen. And in order for that to happen, I think we need a plan from the crypto czar. And David Sachs has not given us a plan. I'm sorry. He's just not. He hasn't. There's no plan, bro. I read the executive order. It's bullshit. There's no plan. It is just acknowledging Bitcoin is cool. It's like, okay, great. We knew that. How are we going to buy more of it? Until we get that plan, I don't think we're going to get any progress on Bitcoin. We can talk about S&P 500 stuff as well. Robinhood did not make the S&P 500. So on Friday, the companies that made the S&P 500, I'm not going to get into my rant again. If you want to see my rant, you can go to market close. I had enough of a rant, but they picked Williams Sonoma, TKO, DoorDash, and Expand Energy. I don't know what to say, dude. DoorDash, I understand. I think that's an amazing company. TKO is freaking UFC and WWE. I don't know how that's part of the 500 most important companies in the United States of America. I'm sorry. Williams Sonoma is Chinese coffee makers and pots and pans that are going to get tariffed in a couple weeks. I don't know how that makes it into the top 500 most important companies of the United States. And then Expand Energy is just another oil and gas company that also does renewables. It's not like Exxon or Chevron. I have barely done any research on it, but just looking at a couple financials, looking at the website, I mean, it does not feel like one of the 500 most important companies in the United States of America. So DoorDash does. I'll give it to DoorDash. Look, it's a phenomenal CEO, phenomenal founder, amazing tech company, great margins. The CEO of DoorDash is on the board of Meta. Like, DoorDash is one of those companies I think will be a much bigger company years from now, and they're going to expand into different product verticals. They have the growth, all that. Like, they to me, you could make an argument. Yeah, that's one of the top 500 companies in the United States of America. So many people have DoorDash on their phone or Uber Eats. Like, it's sort of a household staple name. But Williams Sonoma, are you kidding me? Are you TKO, WWE, Hulk Hogan, UFC, Dana White? Are you kidding me? Like, you got to be kidding. They really decided those companies were more important than what Robinhood has done, particularly over the past 2 years in terms of Robinhood's execution, which has been, I mean, how many superlatives can I give to Robinhood on the stellar execution they've done? What has Williams Sonoma done? Sell a Jura for freaking $4,000? Like how is this? Like, I don't get it. I don't get it, bro. I don't get it. So I'm not mad Robinhood didn't get in, because I'm the guy who kept saying every single day when you guys asked in the chat, do you think Robinhood's going to get in? My answer was no. I don't think. I think the committee is going to take more time. I just thought they would have picked other companies over Robinhood. That's why I'm upset. I'm not upset that Robinhood didn't get in. It gives them more time. Like, they can keep executing and they'll get in probably eventually. But Williams-Sonoma? Like, really? Jason says, I think me and my all new homeowner friends all have Williams-Sonoma stuff in our homes. That's amazing. I'm very happy that you guys shop at Williams-Sonoma and you have a ton of products in your house. Does that mean it's one of the top 500 companies in this country? Like, or the WWE? Like, are we kidding here? The WWE deserves to be in the S&P 500. I don't care how much people enjoy wrestling or UFC or watch the fights or whatever. Does that company have more of an impact than Robinhood? Like, just from a pure economic perspective, like what Robinhood has done for opening up liquidity to markets and bringing retail investors and bringing people 30 years old and under into the stock market, which is one of the most important things in people's life in terms of financial literacy, like that impact compared to watching grown men in underwear fake wrestle, because it's all fake. I found that out the hard way when I was 12 years old and it broke my heart. WWE. Never trusted John Cena or Rey Mysterio or The Undertaker a day after I found that out. UFC is real, but the WWE is fake. I hope everyone knows it's fake. Like that, like grown men fighting in their underwear is more important than Robinhood. I can't get behind that, bro. I can't get behind that. Just like, it was so annoying, bro. I just couldn't believe it. Even though I could believe it, because I've been through this rodeo with Palantir. They picked a lot of weird companies over Palantir for like a year before they let Palantir in. So yes, there's a lot of money in entertainment. I get it. But at that point, it's just like, dude, events, entertainment, like TKO is only a $20 billion company. It's not like it's like some massive company that's so important. And it's like, yeah, it's a $20 billion company. They make a lot of money off the TV advertising and the live events. But like that long-term is a more important company than Robinhood. You got to be kidding me here, bro. And I can say this because I was a WWE fan for a good 5 years. I don't even know if I have any. I used to have the wrestlers, bro. I had the Rey Mysterio mask. I had everything. I had the freaking gloves. I had so much merchandise. I don't think I have it anymore, but I used to love wrestling. And then I realized it was fake and I moved on. I became a grown adult. I'm sorry to all the adults here who like wrestling. Everyone has their own escape. I just grew out of wrestling. By the time I was 12, I was like, all right, I'm done with this. It's boring. And I get that people like it, but still, it's like, I cannot believe that beat Robinhood. So that's what happened on Friday. You can't put an ROI on Kids Joy with wrestling. I mean, look, I enjoyed it at the time, but I just feel like I enjoy making more money on Robinhood than wrestling. And the S&P committee decided to go against it. So it is what it is. Anyway, that's the updates we got for tonight. The culmination of today's, I'm going to talk about a lot of the same stuff tomorrow in the market open and try to get some more charts and data to support all of this. But look, at the end of the day, I think Trump's trying to tank the markets to get bond yields to come down. And I think more and more it is becoming obvious to me that that's what he cares about. And because that's what he cares about, we as investors have to adjust our expectations and adjust our strategies. Now, in terms of adjusting my strategy, other than covered calls, there's really no strategy to me. I mean, I will continue to buy the dip as dips get juicier. This is what I did on Friday. I bought a little bit of NVIDIA, Hood, Grab, and SoFi. And I will keep buying those stocks and plenty more stocks as the dip continues to dip because long-term, I believe in those companies. And I'll sell covered calls against them to generate some premium. But in terms of buying puts or selling out of the market or believing that the market's dead, I don't agree with that thesis yet. I don't think there's still enough data to say. And if anyone who agrees with the thesis that Trump is going to cause a 2022 style recession, now's the time to get the hell out of the market, right? But I think a lot of people are afraid to do that because they know that there's too much momentum on the bull side of the aisle, right? So for those that are annoyed at Trump and they're cursing him out and all that stuff, they're still not selling all their stocks because they know that NVIDIA is still a better deal than the 10-year. Maybe not over the next couple months, but over the next couple of years, or even by the end of the year, it's obvious, at least in my opinion, that NVIDIA will do better than a 10-year bond. So I think that's why, more people are not still out of the markets. Because, I was going to show that we'll end on this. This is what kind of Tom Lee has been talking about for the past couple of days. It's this chart about the 10 best days. And so the reason he's been talking about this is because he's probably been getting a lot of questions from his clients of like, hey, should we sell now that, you know, Trump's deploying this strategy? And he's like, no, because if you miss the 10 best days, you're screwed. So if you look at this chart, S&P 500 annual return versus annual return X 10 best days, when you get rid of the 10 best days, you average 4%. When you are in the markets for the entire time, with including the 10 best days out of the 300 other 55 days, you're averaging close to 20%. So when you're out of the markets, and it's really hard to time what are those 10 best days going to be, because you just never know. And if you think you know, then you might as well start your own hedge fund if you're that good at timing this stuff. But most people aren't. That's why you kind of don't get out of the market. I mean, again, in 2022, unless you sold at the very, very tippy top, which honestly was January 4th, I think that's when the S&P was 478. That's when it was the time to get out. If you sold anywhere after that, especially around that October, November, December time, when Palantir was like $5.84, Tesla was $100, that was not the time to sell. Even though it felt like, it was the time to get out because fear was the highest. So I don't know. We're going to have to see. Volatility is a gift at the end of the day. It creates opportunities. It could create a lot of mental pressure as well, and a lack of peace of mind, but it also creates opportunities where if you've got money, disposable income on the side, and you're going to buy the dip anyway, then you keep buying the dip. You get used to seeing the red on the screen, and in the future, it's probably not going to be red if it's a good company. If it's a crappy company, yeah, you're going to have some issues. If it's a great company, like a Tesla, Nvidia, Microsoft, I mean, I don't think these companies are going anywhere anytime soon. How much does one DCA into multiple stocks? Like, how much should a stock drop before you're DCA into it? I think there's basic barometers some people use. I think, so I have one friend who, if a stock goes down 5% in a day, he buys no matter what, right? That's his personal rule. So if he's bullish on Meta and Meta goes down 5%, he buys. He does not care. I have other friends that say, look, if I have $10,000 to buy the dip, when we go down 10%, I'm going to spend $2,500. When we go down 15%, I'm going to spend the next $2,500. So every 5% increases their allocation of spend. Some people say, hey, 10% down, I spend 75% of what I was going to use to buy the dip, and I wait for the next 10% to spend the next 25%. It really has to be your prerogative based on your own personal financial situation. I think asking Grok or ChatGPT to even come up with a plan of saying, hey, I have XYZ amount of money. Here's 5 stocks I want to buy the dip on. Create a plan for me of how much I should allocate based on percentage declines in these stocks, and come up with a weekly or monthly DCA strategy for me. I mean, it'll come up with something really good and reasonable, and it'll give you the pros and cons of it. But I think everyone should have a strategy. But yeah, it's very subjective. I mean, it really depends on portfolio size, what stocks you like, what stocks you don't like. If you're heavily already in a name, so like Palantir, I don't feel the need to buy the dip because I'm already so heavy in it. Right? Same thing with Hood. It's like I really haven't gone aggressive buying Hood because I'm already so heavy in it. Now, Tesla, I'm not really heavy in it. And I mean, if Tesla gets below 250, that gets very exciting. Even if it could go even further below 250, given my allocation is very minimal, I would get more excited, right? So it really just depends on how you want to play it out. Okay, cool. I think that's it for me. We'll be live tomorrow on the Market Open. Again, the summary of everything we talked about today is that it does look more and more likely that Trump is trying to create some volatility in the markets to get bond yields to come down. Once those yields come down, maybe this volatile narrative starts to change. Tomorrow, we've got a lot of updates in regards to what's going on with tariffs. I think Trump, Mexico, and Canada are going to be speaking in either tomorrow or the day after tomorrow on updates with their tariffs. We also have CPI coming out on Tuesday. Wednesday. So that's going to be important. We have the jobs number coming out on Tuesday in terms of JOLTS. And then in terms of earnings, I think we have a few more earnings this week. This is the last week of earnings. Yeah, we have Adobe, we have Path, we have Ulta Beauty, we have DocuSign, we have Dix. That's always a great one. We have Oracle. That's a big one tomorrow. All right, Oracle. That'll be very important. And then we have Kohl's. And then we have Asana. That's it. So those are going to be the earnings we looked at this week. And then we'll keep going from there. All right, cool. Thank you, everybody. Appreciate it. Thank you all for joining. We'll be back tomorrow on the Market Open. Look, we are down right now overnight. Maybe this gets eaten up in the pre-markets, and then we'll see what happens at 9:30. Obviously, there'll probably be some headlines tomorrow that can create some more of this volatility. We are right at that 200-day moving average, so if we get a bounce tomorrow, it wouldn't surprise me. But given kind of how futures are shaping up, it looks like we might go a little bit more red, but we will see tomorrow as we play it out. All right, cool. Thank you, everybody. I will see you guys tomorrow morning. I'm going to sleep, even though I slept all weekend. Dude, I slept a lot this weekend. I slept so much. I feel like I got all my sleep that I missed out on last week. There's not going to be a market close on Tuesday. So Tuesday, there's just going to be a market open. Going to be flying on Tuesday. And then Wednesday, we'll have a market open. And we'll go through the regular schedule from there. But yeah, it'll be a fun event this weekend as well that you guys will find out about. And that one should be fun later this week as well. All right, cool. Bye, everybody. Thank you, guys. I'll see you guys tomorrow on the market open. Bye, everybody.